Most people don't underperform because they pick the wrong ETF. They underperform because they panic, tinker, and act emotionally. So let's make 2026 the year you build a process you can actually stick to. Have a plan and stick to it, or know what you're going to do before it happens. A lot of people will work this out on the fly, and then an event will happen that they're not expecting, and they rush into a decision, and they tend to be emotionally charged. Or they then go and hunt out someone else to copy because they can't make up their own mind themselves in a short space of time. And then because you're copying someone else, you're then potentially making a decision that's not suited to you. You're never going to cover every scenario, but it can be quite simple. It could be what happens if the market goes down 10% or 20%. It could be that if you're investing regularly, you decide that you're not going to do anything, and actually you'll be better off because you're getting in at a lower price. But that's still a decision. And if you build that into your strategy, when that dip does come, you're not going to panic because you've already decided that if that's the case, you do nothing at all. You could also have a plan on the upside as well. What if the market goes up 10 or 20%? Again, it could be you do absolutely nothing, especially if you're a long-term investor. You just want to let it run. We'll come on to allocation, but it could be that you want to rebalance your portfolio. Depending on the weightings that you set across different asset classes, it could be that some areas outperformed, and thereby you want to bring it back to the weightings that you set to keep your risk tolerance in check. The two key things you really want to avoid is selling when the market is down and buying when the market is up. And again, if you're just regularly investing, you might not have to do anything. But it could be, if you're a bit more of an active player, that you might want to deploy some more cash when the market is down. Say we've had a market crash of 20%. Depending on how the crash has occurred, that might be a really good time to get into the market. And if the market has come up 20% really quickly, and it's likely that it might not sustain, that could be the time you might want to take some profit off the table, maybe move it to some safer assets. But try to have a rough strategy and plan so you know what you're going to do before it happens, and then you're less likely to panic and make a bad decision. Decide what you can invest in advance. What a lot of people tend to do is they'll spend throughout the month, and then they'll see whatever they've got left, then they'll invest that. This is all about paying yourself first. So you set up a direct debit, so it automatically comes out as soon as you get paid or whenever you want to have it come out in the month. And then what if you've got left after you've invested? That's what you've got left to spend. What can be really useful, especially at the end of the year, is to look back over the year and do a little bit of a budget. See where you've spent your money, trying to group it into categories. And then you can see where you potentially can save. And then work out what you can afford to invest, take that off automatically, and then split everything else into what you've got left to spend. So much of investing is about psychology and staying consistent. So it's much better that you set a slightly more realistic goal. It might be a slightly lower amount that you invest per month, rather than being too optimistic, set a really high amount that you might only be able to do for a couple of months, but you can't sustain it long term. So much of this is about building a habit, staying consistent, and keeping yourself accountable. Decide how much risk and volatility you can handle. Start with asset classes and then move down into products. It could be quite simple. You might want to have the majority in a core ETF. It could be a global ETF, and that's going to be 80 or 90% of your portfolio. And then you might have a slight tilt to a certain region. It could be a slightly different asset class. It could be into some bonds or some money markets. But decide those percentages ahead of time and then think about the products. What might happen is during the year, a certain ETF or a certain company or region might really outperform, but it might not fit into the allocations that you've set. And thereby you might get tempted because it's performing really well. And that's fine, you can still change your mind, but just make sure it still fits into the allocation that you've set. So if you decide that you want 80% equity and 20% bonds, if equity is massively outperforming and that drifts to 90% and 10, then you've got to think about whether it's time to rebalance because it then drifted away from what you set as your portfolio allocation structure. Decide how active you want to be. Are you going to be quite passive and pick a global ETF, which is going to be quite hands-off? You're not picking a side. Or do you want to be a little bit more involved and pick a particular region or a sector? With a global ETF, it's never likely going to be the best performing ETF. But the problem is picking the right one that's going to beat it. So it's much more of a safer bet because you're simply just capturing the global economy and the global market. Where by going more niche, whether that's a particular country, sector, region, you're having a more active play because you're trying to beat the market essentially. But what tends to happen, especially if you start with a global ETF, a certain company or a sector will start outperforming. In the last couple of years, you could look at big tech or specifically Nvidia, and then people go, I want to have more of a tilt towards Nvidia or big tech. So they either start buying the NASDAQ or they'll even go individual companies, not always appreciating how much of their global ETF is already weighted towards these big companies. So just make sure you're comfortable with the allocation you've got before you make more active plays. If you've got more of an active portfolio, it could be that you've allocated specific percentages to certain regions. And what you've got to decide then is how much you want that to drift before you rebalance. Obviously, you want to let runners run to a certain extent, but at the same time, you've set those percentages for a reason. You want to stay diversified. So if a particular sector or region is massively outperforming, you've got to set an amount that you're willing to let it drift. It could be as simple as letting it drift maybe 5 or 10%. And then at which point you start selling off the outperforming asset and start buying some of the ones that have been underperforming. By deciding those thresholds in advance, you're simply just implementing your plan. You're not having to make it up as you go when you could act emotionally. It also encourages you to buy low and sell high, because when you rebalance, you're taking it from the outperforming assets and put it into the underperforming assets. Again, it could be part of your strategy that you don't bring it back all the way to your weightings. So it could be that you don't take all of the profit from an outperforming sector. It could be that you just slightly reduce it. So you're still letting the winners run to a certain extent, but you're still capitalizing on taking that profit essentially. Make sure you're aware of all the costs involved with investing. This is an easy one to put off. It could be that you have a platform fee, but because you've used that platform for a while, it's just easier to stick with that platform. But review that over a long period of time, even if it's just 0.5%. Over a very long period of time, that can really eat into your profit. Have a look at your funds and ETFs and make sure you're comfortable with all the ongoing charges. Have a shop around and see if there's any alternatives that are slightly cheaper. But don't put it all on the ongoing charge. Have a look at the size of the fund as well. Spread and liquidity is a big thing that is underplayed when looking at ETFs. It could be when you're comparing two ETFs, you simply just pick the one with the lower ongoing charge. But if the fund that is slightly more expensive has a much bigger size, it's likely to have a tighter spread. That's the difference between the buy and the sell price. That's going to fluctuate throughout the day, depending on supply and demand. But generally, a larger fund is going to have a tighter spread, have more liquidity. And therefore, depending on how often you buy and sell, you could be saving money by picking a bigger fund, even though it has a slightly more expensive ongoing charge. And of course, make sure you're utilizing tax wrappers like ISAs and pensions. The quickest way to grow your investments is to deposit more money. I know that sounds stupidly simple, but have a plan on how you can potentially increase how much you invest. It could be that you want to negotiate a pay rise, but have a plan about how you're going to do that. What are your selling points? Are there new skills that you've learned this year that you could then take to your boss? And make sure you've got a plan of how you're going to ask for it. You could take a step back from that and then think about what skills you need to develop or need to learn. Are there any courses or qualifications that you might need to take that could potentially increase your income in the future? It could be that you're thinking about a side income, something that you are potentially developing on the side, but have a plan about what that looks like and how you can develop that alongside your current work. And when you do get an increase in income, make sure you're not letting lifestyle creep eat into it. So when your income is going up, it's very easy to then let all your lifestyle expenses go up at the same time. But if you want to invest more, you've got to keep those expenses the same. And any increases in income, you'll be able to put that into your investments. This comes down to what your priorities are. If you want to enjoy and spend that money, that's absolutely fine. But then at the same time, you can't also have the priority of wanting to invest for the future or to grow your account. So you've got to really lay out your priorities. This is a big one for investors that are slightly more active in the market. See how you've performed over the previous year. Did you beat the market? And how much did you under or overperform it? If you've underperformed it, especially if you've done that for a couple of years, you have to question whether it's worth being that active in the market. You've probably put more time and effort into making those active plays, where you could have saved that time and simply just invested into a global ETF. You could have a small portfolio tilt. Say the core is 80% in global ETFs, and then that 20%, you're a little bit more involved making some active plays. But make sure you're comfortable with the reasons why you're doing it. If you're underperforming, but you enjoy picking those stocks or doing some research, then that's absolutely fine because you enjoy it. But make sure you're then comfortable with potentially having a less return. You can also see what reactions you made. So you can look back over the previous year, see what media developments there were, seeing when there was periods when the market moved very quickly. Did you make any decisions? Did you sit back and do nothing? Because you can then learn from that. If you reacted in an emotional way, maybe you panic sold when the market was dropping. Have a look at what the market has done since then. Not to say the market's always going to repeat exactly the same way, but try to learn from making those emotional decisions. So if something similar happens in the future, you had a rough idea about how you might feel, and then you can learn from it and make a better decision in the future. If you want to discuss any of this further, you can do so in my Discord community, which you can join using the top link down below. Hope you found that useful. Thanks for watching, and I'll catch you in the next one.